We can go ahead and start by everybody introducing themselves. We'll introduce ourselves to the viewers so everybody knows who we are. We're not just here to talk to you and nobody knows who we are. Since this is your establishment, we can start off. You can introduce yourself to the people, tell them who you are, what you do.
Definitely. I'm Vince Clark. I'm the owner of Vince Clark State Farm here in Kankakee. At the end of the day, all we do is help people understand the insurance products, help people understand life insurance specifically, car insurance, homeowners insurance, and we really just try to help the community out as best as we can. This is one of my team members, Dave, who's with me here today, so go ahead and introduce yourself too.
I'm Dave. I'm also from Kankakee. Work here with Vince on an everyday basis. We just try to bring the value to our customers and just try to properly protect everybody.
Oh, well, I guess I'm next. I'm Jorge from Jorge Juarez from Coldwell Banker, just recently licensed real estate broker. Been working with Norman for a little bit, and I'm kind of just learning, but I've also learned quite a bit in this little journey that I've already gone in.
And I'm Jeremy Gates. I'm a loan officer with Midland States Bank. Just trying to make it happen. We do offer down payment assistance. If you have any questions or you're a first-time home buyer, you can probably reach me better through Norm than my work phone. But happy to be here.
All right, and then last but not least, I guess, since it's my page, my name is Norman. Hashtag Buy with Norm, Norman Gaskin. We're also with Coldwell Banker. This whole event is just to help out people that are having questions, wanting to know more about home buying, wanting to know about life insurance, or has questions about it. Just in general, we're here to help. Any of the topics you see on the comment section of the live, you can ask them in the comment section. If you don't want everybody to know your question, feel free to put it in an inbox message to anybody that's tagged on this post, and we can answer it publicly even though they don't know who asked. It's just to make everyone comfortable. I guess to start out, just to be clear, if you have any questions while we're talking, go ahead and drop the questions in the comment section, and we'll be going about our merry way and talking about topics. And if you have any questions on one of those topics, or even if it's already passed, feel free to ask when you chime in. First order of business, I guess we will start with what I think is the most important, is explaining life insurance. I sell houses, so I can't knock life insurance. I also have life insurance myself. So I brought the professionals in to be able to explain it to people that may not know. This could be anyone from the ages of 18 and up, 16, it can apply to all ages. So we want to make sure we give that information to anybody that's wanted, and feel free to drop questions in.
For sure. Did you want to go over product, or did you want to go over analysis?
Give us all
I
of it.
do the product
Okay.
analysis. All right. So when it comes to life insurance, we do have 3 products that we like to offer. We have a term product, we have a return of premium, and we also have a whole life product. Now, all 3 work in different ways. So we try to say, we try to use an analogy, kind of go hand in hand. We say a term product is similar to renting. We say return of premium is almost similar to kind of staying with your parents. And we say whole life is similar to buying a house. Now, the reason why I would say we say the term is kind of like renting is, at some point you got to make a decision, and at the end of it, you got to either renew, or you even have to, how can I put it?
Basically, end the policy.
Yeah, end the policy, or you either have to renew at a newer age. Now, with the return of premium, that one is a little different, just because at the end of that term, you do actually get that money back. So we kind of say that's like living with your parents. You have that savings account. And then whole life, it has that cash value in it. So we kind of say that one is almost like owning a home, because it does have that cash value, which is similar to that equity built up in the home.
Right, and then to add to that, term life insurance is, honestly, it's really important for everyone. It's more so to protect your now. So a lot of us, especially a lot of younger people, they have a lot of things going on. They have families, they have young families, they have maybe a mortgage because they just purchased a house with Norm. They have a lot of things going on in their life, and if something were to happen to us right now, there's a lot of things that need to be taken care of financially. So whether you go with the regular term or return of premium to protect your now and your money, those are both good options. However, what we like to talk about with the whole life is that's something that's needed for everyone. At the end of the day, we all have to die. And hopefully we're 80, 90 years old when that does happen. And when that does happen, there won't be any more term insurance there. So you have to have that whole life in place to take care of final expenses and anything else that you want to leave behind for your family. Dave mentioned cash value. I know there's a lot of different questions on cash value out there. The simplest way we like to put it or explain cash value is it's simply kind of like most people are familiar with equity in the house. Like you pay your mortgage every single month. A portion of that mortgage goes towards the equity in your house, and then another portion goes towards taxes, all the other stuff that you got to take care of. Anytime you make a life insurance payment in a whole life, it works the same way. A portion goes towards taking care of the life insurance itself, and then a smaller portion goes into cash value, and this is money that you have access to, and you can borrow from your life insurance policy using that cash value as well. So those are like the biggest things that I wanted to touch on in regards to life insurance and that we wanted to touch on. So definitely, if you have any questions, feel free to reach out to us here at the office, Vince Clark State Farm, right here at Kankakee. It looks like we got a few questions
Yes, we
already.
do. So we'll backtrack. We'll go to your question, Scott. Scott's question is, what might each of you do that is unique or different as compared to any other agents? I'm assuming in our own rights, respectful professions.
For sure.
That's a very good question. Very out there, real quick. So I will say it for myself personally. I market myself on being authentic at all times. So, say for instance, I've had people that say they won't trust what I say because I'm out for my best interest to get paid, and that takes. It's personal to me because I got into real estate to help people. At the end of the day, if I do not get you a house of your liking, and you close on it, you do everything you need to do to get there, I don't get paid. So it's strictly all my time until it isn't my time anymore and you go to somebody else or whatever it may be. But me personally, I market myself on just making sure I'm personable, I'm available, and I answer pretty much all questions that any buyer of mine has, or even sellers of properties. I'm very personable and I'm honest. I don't hold anything back. I make sure I make myself available as well as my knowledge available. So that would be me personally answering that question.
For me, like Norm said, I'm out to help people, but one little difference for me is I also got into the business to make money. So from the lending end, if homes don't close, I don't get paid. But here at Midland, we have different forms of down payment assistance that we wield like weapons. So if you have credit but no money, money but no credit, we have a different scenario for everybody. Mortgages, everyone has their own story with them. I love dealing with everybody's individual files, and I really feel like Midland and me especially, we go above and beyond to make sure you close.
All right,
All right, well, me, I guess, as a quote-unquote, like, newer agent, you probably think that I probably don't have the experience or, with like, people usually will get that with newer agents. The way I like to think of it as, regardless, we all have to know, like, the material for, like, doing real estate, anything we're in, we have to know the material. So the way I see it in my case, as a newer agent, you do get more time with me, so I may not be doing as many deals now, so your deal might be a little more important to me, meaning I put more time and more effort into it. So for me, that would be the case, but overall, I think we all got into it to help people. I think we all got into it to, like, because we've all seen, the people that try to, like, take advantage of you because, again, they think that, you're trying, the more money, the better. So, I think everybody's case here is different, but we all got in on it to help people, to help our community specifically. So, yeah, that would be my side of it.
Okay. And to go along with that, I think one thing that kind of separates me is I'm all here for the people in our community as well. And I'm very transparent, very, I think, personable, just try to help people, bring a certain type of energy. I try to answer the phone every time, and I just try to make sure that everybody is properly protected and that value is there when it does come to insurance.
Definitely. And, as owner of this agency here, it was really important for me to open up in the city of Kankakee. Like, I'm from here. So at the end of the day, when it comes to insurance, I learned that a lot of people have insurance, but they don't even know how it works. So myself, my team included, the biggest thing that we do is we educate. The price is not even up to us. Underwriters determine the price. So all we can do is help people out, show them how this stuff works, and even if they can't come with us, they at least leave this office knowing exactly how the insurance should work. And if it's not with us, they go back to their current insurance and say, hey, I need to make these changes. So at the end of the day, all we do, like everyone else, we help people, we educate people. I know in this industry, a lot of people, like I said, don't understand how the stuff works, but come in, get a quote from us. At the very least, even if we're not able to help you out on the price side, you'll have a much better understanding on how all this works, and you'll be able to have a better conversation with your agent. So that's what makes our agency here different.
Okay, so back to your life insurance. We started with that. So I know a lot of people that I know don't have life insurance because they feel like it's an unnecessary expense or it costs too much. So if you were to say for the life insurance that covers you for the day you die, how much would you just average it out for a regular average amount? How much would that cost a month for anybody
Right.
in life insurance?
I mean, if we're talking whole life, guaranteed to pay out, it really varies. Like if you're a smoker, non-smoker, how old you are. But typically, a lot of people that we work with are younger. I mean, of course, we work with older people too. But if you're like 25 and you're looking for something like a $25,000 whole life insurance policy and you're a non-smoker to take care of final expenses down the line, I would say something like that may run like $30 a month, just off the top of my head. I can't be super exact, but it should be around $30 a month for a healthy, non-smoker 25-year-old male. If you're a woman, it's even cheaper. You know what I mean? So that's about the price range for something like $25,000. Now we have a full conversation. We're not just going to sling $25,000 whole life policies, right? What we do is we sit down and we actually go through what's called a life analysis. We talk about the liabilities that you have. We talk about your current income, how long you would like to provide that income for your family. We talk about final expenses, what that looks like, and we talk about anything that you'll leave behind for a legacy. And we talk about the total amount that is needed for life insurance, and then we kind of determine a budget based on what you tell us and kind of figure out the rest from there. So it's a lot that kind of goes into it. It's like a, 20, 30-minute conversation, but at the end of the day, it'll be a plan, something that you come up with or something that makes sense to you, and then we'll work with the budget to make sure, like, whatever that needs to be, it fits as well.
Okay, so you would say $1 a day could take that financial burden away.
Right. $1 a day is for sure. If you're healthy around, in your 20s, $1 a day can definitely make sure your family is squared away whenever your time does come.
So I guess to help everybody's understanding in mind, you think it's better when you're younger to start your life insurance than when you're older?
100%. The younger you are, the better it is, and that's what's so kind of catch-22 about it. A lot of young people, they don't try to think about it. They don't try to look into it.
They don't think about their death. They don't
Right.
think about life.
No one thinks
So,
about that.
I guess for transparency myself, I have multiple life insurance policies. I'm a big believer in it. Myself, I started my life insurance when I was 21 or 20, one of the two.
Right.
Before I bought my first house, I had life insurance.
Right.
So,
Same.
I think I paid $22 a month, and that gives me, I don't even remember, it was so long ago, but I think it's somewhere to the tune of like $30,000 I get for, whoever succeeds me when I die, whoever my beneficiaries are. For $22.32 exactly, actually, because it still comes out of my account, obviously, to this day, it's auto payment. But I feel like, personally, that's a good investment for me.
Yeah.
$22 I can blow on food without blinking,
Right.
or vice versa.
Right,
I could spend it on something great. But I feel like $22 was what I started with. I have multiple, so we'll just go with the basic one, the whole, I think that would be term.
Yeah.
That term. So
yeah.
that's term, that's just a flat payment, doesn't pay me anything right now. But when I pass, that then is already paid off over my term that I paid it, and it goes to my successors or my beneficiaries. So I feel like that's beneficial. I think it was good. Now I have a few, and I'm working on getting more because I'm a big believer in them. More so on the investment side of the life insurance now to make that investment and a tax difference. So we won't get into the nitty gritty of that unless somebody has that question. But I'm looking at it more for a tax benefit as a business person. I am incorporated, things like that. So as far as the benefits of tax write-offs, life insurance has a benefit to that. I don't know the ins and outs of it yet. That's why I won't talk about it per se. And I don't know if anybody has it perfected. But I know that's a big thing for me now that I already have the regular practice out of the way and I'm covered for the most part when I die. But now to cover my assets and then also be able to use that money while I'm alive.
Right.
So
right.
life insurance is not just for death. It can also be for while you're alive.
Right,
I guess that's a big thing.
and that's where the cash value kind of plays a major role. Like, especially if you're younger, or even you don't even have to be super young, but if you're able to put more money into life insurance to increase how much cash value you got, I mean, you can do some really cool things with it. Like, essentially, if you wanted to buy a car, you had enough cash value besides your life insurance, you didn't want to like take a credit hit for financing, or if you want to buy a house and you want to use part of your life insurance cash value for the down payment, like there's some things that you can do to utilize your life insurance while you're still alive, you know, by using that cash value and accessing that cash value. Now that's getting more into the weeds and more in depth with it. But the biggest thing is to at least make sure your family's taking care of everything where it happened to you. That's step number one. Once we have the family taken care of, then we can start diving into, okay, like let's look at cash value. How can I utilize that? How does it work? How do I increase it or get large amounts of it quickly? Like we can also talk on those and have those conversations as well, and how you can kind of create your own family bank. But yeah, like I said, step number one, make sure the family's taken care of. Once we do that, and then if you still want to kind of put more money into life insurance, we can definitely talk about some creative ways to do some cool things with life insurance using the cash value as well.
All right. Well, I guess we'll leave that alone for now. If anybody has any questions in regards to life insurance, feel free to drop them in the comment section or send a message to anybody on the panel, and we can be sure to answer for you either on here or outside of that as well. The next thing we'll move on to is home buying. Home buying and credit. We'll tie them together because they're big on each side of it, not just for home buying, but they go together for the conversation. So I guess we'll spin it to Jeremy to see how you can buy a house. I'm a real estate agent. He actually works with the bank, so he's the man that when you call me and say, "Hey, Norm, I'm ready to buy a house. What do? I can give you pointers, but until you talk to him or somebody like him, I can't do anything for you unless you come with cash, which might be many ways to get that. You can be coming from life insurance. Crazy part is I've had a lot of clients, at least in my time being in real estate, I've had 6 clients come to me with big cash checks or bank statements to say, "Hey, I'm ready to buy a house." I don't usually ask, but I make it my practice to try to find out where money comes from. And 90% of those people, the money came from life insurance policies from grandparents or parents above them that left them something and they decided to do something responsible with it. Power to those people. I won't disclose those names because obviously that's private information. But at least they use that life insurance to benefit, and I'm sure the people before them would appreciate that to set themselves ahead and get themselves in a place where now they have money that didn't just disappear. It's now something that could either make money over time or just stay that same, and you can still sell it and get that money back at some point. But we'll get to that later. That's a whole different thing. Jeremy, give us a little something about home buying, what it takes, what you need, what are the ways you can do it. A lot of people will tell me, "Hey, what credit score do I need?" Give them a rundown of how that works.
Where do we start? So usually to buy a home, you want at least a 620 credit score. That's what Midland requires. For cash,
You work at Midland Bank?
yeah, I work at Midland.
Okay, just checking. I didn't know why you said Midland. I'm just making sure.
Oh yeah.
Okay.
So Midland requires a 620 credit score. There's various types of loan, and as your loan officer, I'm usually the guy that structures it the best way possible for you. There are some people that want the cheapest option. There are some people that want the best value, and so that's my job. A 620 credit score, a couple grand in the bank. Please don't dispute stuff on Credit Karma. If you got too much in dispute, it's not included in your debt to income, and it'll get flagged by automated underwriting. Usually best practice is to pay off collection accounts. Even if you just go contact them, get a statement, and we pay it at close. There's various, yes sir.
What's the debt to income ratio? What is that?
It's your debts against your income. Anything that reports to your credit will be included in that. So like if you co-sign on a car, actually I had this happen the other day. Lady co-signed for a car, didn't know that they counted against her. Now you got $700 in car payments, and even though yours is only $200, you should definitely take your credit score seriously. I always tell people that if someone can't get it on their own, there's usually a reason for that. You extending that hand, that's helpful, but there's other ways to do that, such as the authorized user route. And that's usually my suggestion. Put somebody on a credit card, don't give them the credit card. You help them, you give them a score, and then they can go do what they want with it.
Is that legal?
Yeah.
Okay.
There you go.
Just that's for the audience. I know it is, but a lot of people, being in real estate, I get questions for everything.
Yeah.
And that's one. How can I get my credit better? I do everything I should. Now, a lot of times people don't know what that is, so they think that just because they're paying stuff on time, they're doing everything they could. They might not even have any credit being used. Like they're paying bills on time. A lot of people think that's part of their credit. Unless it reports to the credit bureau, that's not even part of your credit. You're just paying your bills because you're supposed to. If you're in a rental situation, there's a possibility that rental can report to a credit agency. It just depends on who you're renting from. If you're in a big metropolitan area, it's more likely. But on a regular scale, small scale, it usually does not report to the credit bureaus. I get crazy questions like, hey, I pay everything on time. I got a 580 credit score. And me personally, I'll sit down with people and I'll have them pull up whatever they got on their phone while I'm on the phone with them. Hey, what do you see when you look at your payment history? Oh, it's 100%. Or sometimes like it's 0%. I'm like, oh, 0% as in you don't pay nothing on time? Well, I don't have any credit cards. I don't really have any loans. I mean, I guess I don't have any credit. Okay, let's start there. Because the conversation you have when you go to a bank is you have to prove that you're a responsible borrower.
Yeah.
If you never borrowed anything, technically you're not responsible. It sounds messed up to say, but the only way, at least that I know of in America, to have credit is to have debt. Responsible debt, per se.
Yeah.
So like a lot of people then will follow up after that and they'll say, all right, well, how many credit cards is a good amount? We had this conversation before. I myself have over, I think, 12 credit cards. My credit score is a decent credit score. I'm in the 7 range, so I'm doing all right. But it's about the responsibility, not necessarily having the debt. I have a whole bunch of credit cards. I barely use it. If I use them, I pay them off right away. Sorry. That then positively reflects my credit score. My credit limits can increase over time, things like that. So the credit I'm not even using just because I have it is building my credit score. The time that you have credit builds your credit score. So those credit cards that I started with when I was 20, I still have those credit cards. Now I wouldn't advise going out and getting credit cards just because you can. Just go and swipe, hey, let me get a credit card, because then if you're not responsible, you then use those credit cards and you rack up that debt. And then it's hard to pay off that debt because now you only got to pay the minimum. That's cool. Minimum. And then you're in a bind. So you've been paying that minimum. While you're paying that minimum, you're gaining interest on those credit cards. So it's a double whammy. If you're not responsible, they can also hurt you and not just help you. Sure, your credit score will reflect that you've had credit cards for a certain amount of time, but then your debt's piling up because you're not taking care of it the proper way, whatever that way is for you.
Right.
Some people might value having debt and paying the minimum for other things in their life. There could be many scenarios. So I'm not saying having credit card debt or any debt is bad. It's just about the responsibility of having it. From my experience and working with a lot of buyers that I talk to, people that are working on getting ready, it's about the responsibility of having debt. Not having debt is a bad thing. That's the biggest misconception people have. I ain't getting no loans because that ain't happening. They ain't gonna get me. That's what people say. They ain't gonna get me. Who is they and why? Why are they trying to get you?
Yeah.
It's about the responsibility you have when you get that debt. Because you can go to a dealership. It's easy to buy a car, very hard to buy a house. I can go to a dealership at 18 years old with barely any job and buy a car because they capitalize off you being irresponsible with your debt.
Right.
So you go get that car at 18 with barely any credit, you're probably gonna have a 18% interest rate, 20% interest rate, or even higher. Depends on what it is.
I've seen it, yeah.
But they'll sign that line because at the car dealership, that's their job. Not saying that all those scenarios are right, but when I was 18, that's what happened to me, or 19, one of the two. I was young. But me reading and following up, there's ways around that. But either way, you start out bad because that's how you start out. If you don't have any credit and your parents haven't put you on cards or whatever it may be when you're younger, you start out from scratch basically, and the bank treats it as such. And then you go up from there based on how you do with that first one. So if you're responsible, you pay on time, you don't get it repoed, no late payments, that credit score then increases. So now the second time you go to that dealership, 4 or 5, in my case, 1 year later, you then now having a scenario where you can now have a 7% interest rate and so forth. So it's about the responsibility, not just the credit itself. It's how you manage the debt that you have.
And I will also add, when I was young, I was 18, 19, I think my mom just got me a credit card. It was a Discover credit card. And I was in college still, and she basically told me, she was like, hey, use this credit card for everything. Don't use your debit card, use the credit card. And keep your cash in the bank. After the statement comes out, take the cash out the bank, transfer it to the credit card, and just pay it. You know what I mean? You're doing a couple things. And I still do this to this day with my business. I run all my business expenses through a credit card. Because at the end of the day, like, a lot of these cards, they give cash back or points or something like that too. So although you're using this credit card, a lot of people are afraid of the interest. Like, if you're paying it off every month and you're just saving your cash, right? And then until after the statement comes out, you hardly pay any interest, but you're getting all this free money from credit card companies too. And then you're showing that you're using the card, so that's another easy way to get your limits increased, because they're like, yeah, we want to keep you. Do you need more credit because you spend money with us? Even though you're just getting free money from them, they just see that you spend. Like, that's what credit cards really care about too. So definitely keep that in mind as well.
There you go. That's exactly right. A lot of people are afraid of debt. It happens all the time. Oh, I listen to Dave Ramsey, so I should be good for a home. And like I pull credit and there's nothing there. There's one thing there that they paid off, 3 years ago, so you don't have a score, buddy. And it's just wrong. And a lot of people are afraid of debt because they just don't use it appropriately. Like what Vince said. Technically, you should just get a credit card, and you should put everything on it, and then you should just pay it off. Most cards don't charge interest if it's paid in the first 30 days. On top of that, it's safer. With fraud going around, how easy is it to just, hey, this is fraud? And you're not, your money's not fraud. You don't have to worry about that. You can easily cancel a payment, you can easily dispute a charge. So it's safer. Your money's safe in the bank. Like, I wouldn't use a debit card if, I have a family member that's afraid of using credit cards. But my best advice to anybody is a credit card. I have a hard time with car payments because you're paying interest on a depreciating asset. But for homes, the interest you pay on a mortgage, it comes off your taxes. And the principal goes towards your equity. It's literally a long-term savings plan. Oh, you want to go buy a new home? Use the equity from your old home. Oh, you want to increase your value? Go get a HELOC. Redo your bathroom.
What's a HELOC?
That's going to be a home equity line of credit. It's basically a credit card against the extra value in your home. A lot of banks go up to 80-85%. Right now, with the state of real estate, a lot of them go up to like 70. But either way, if you got a lot of equity in your home, and you don't have the money to do repairs, to put a roof, you want to sell it, it's not up to date, you can accomplish a lot. Like a home is a financial tool.
If you know how to use it.
If you know how to use it.
Just bringing it back to that whole credit card thing, like, oh yeah, I put everything on a credit card and then you don't pay it all off at the end of the month, and now you're stuck with debt. And then that's not responsible debt. So yeah, I think that's one of the biggest things too, is like people will think like, oh, I'll pay it all off at the end. And I know because I've been stuck in that trap at one point where like, oh, I'll pay it all off at the end, and then
Something
get to it, something comes up, and then you're like, I can't.
I'll pay next time. Let me pay the minimum.
Yeah, and then you're just like, let me pay the minimum, and then next month comes up and like, gotta pay the minimum.
Yeah.
And that's
I had a question for Jeremy though. You mentioned the HELOC.
yeah.
Elaborate on the HELOC and like how can like some of that stuff be beneficial, and then like tell me like maybe a couple cons to doing a HELOC as well.
The benefit to a HELOC is some people just put a HELOC on their home and don't use it until something comes up. Like, oh, I got, basically a cash reserve. Something happens to the car, need a roof, kid needs to go to college. Sometimes the interest rates on those are much lower than what you'd pay on, like a student loan. And so there's all kinds of scenarios where it's like it's better to put it against the house. Oh, you got a car payment and you're paying 12% interest. Mortgage rates are 3.2 right now. So and you're paying interest against an appreciating asset, and it's tax deductible. Mm-hmm. And so to me, putting anything against a house usually makes more sense.
Sure.
And it's basically a credit card. That's the upside to it. The downside to it is the payments are usually interest only. So that balance doesn't move unless you make a conscious effort to move it.
How long do they last? I hear that HELOCs are like a 3-year thing, or is that not true?
It depends on the bank. Some do 3, some do 5. Midland does 10, I believe. So then there you go.
So you got a 10-year line of credit.
Based on you having your house.
So
Right.
if you never use the money from the HELOC, is that still like benefiting your credit?
No. It probably reports, so I guess kind of in a weird way, but
It's an open account kind of thing.
yeah, it's
Right.
just literally a 10-year history, I guess.
Okay.
So it can't help you. I mean, even if you use it or not and pay it off, it can help you either way.
There you
So,
go.
we have a question that says, when does it become a financial tool? Now, you can answer that, I can answer that. I don't know who can answer that, but it's a lot of answers.
What do you mean?
When does your house become a financial tool?
As soon as you have equity in it. As soon as you start to build equity, like a lot of people have problems with savings accounts. You making your house payment, that is a savings. That's your living expense. That's your savings account. That's something that's going to help with tax deductions. Like buying a house is so much smarter than renting. Why do you think the government implemented FHA? It's literally to help people get out of the renter's trap. Oh, that's hard too. Now you got down payment assistance from state agencies. They're trying to help any way they can because the renter's trap, what are you doing for your landlord? You're building their equity. They're playing the same game. You're just doing it for them.
That's true. So, just to keep on the same questioner, Denise says, obviously, when does it become a financial tool? And then she said on top of that, what is a HELOC? So, I guess I'll help you out because you already somewhat said it. But a HELOC is basically a loan you can take out against the equity of your home. So you have to pay down to at least under 80% in most cases, or 25% of that home's value, current value. So let's say you bought a house for $150,000. Let's say what's 20?
Should've just done 100,000.
Let's say $100,000. So you bought a house for $100,000, and then you paid it down to, let's say, $80,000 now. Now you're at the 80% threshold, and depends on the bank you go to. You could probably take out a small HELOC, but if you paid down the house, you've been in the house 10 years, you paid it down 40%, you can take out that basically that 20% difference in equity that you have, because most banks won't let you take out up to 100%. You'll have to get to 80%, because if you take out on 100% and then something happens where it goes up and down a little bit, they have no cushion. But a HELOC is basically a line of credit against the equity you have in your home. So if you just bought a brand new house, the odds of you having much equity is very low unless something goes crazy. You get a building built next to your house that raises the value by $100,000, which happens in big metropolitan areas, not necessarily in rural areas, but it does happen. But that's what a HELOC is, HELOC, home equity line of credit. So that hopefully answers that question. Let's see. And then also somebody said, I don't know if anybody saw that, it says an easy tip to pay over $1 over the minimum also helps build your credit. So whoever that applies to, go ahead and use that to your advantage. I did not know that, so that's a good tool. Thank you, Scott.
Also, more payments are better. If you're gonna pay $100, it's better to pay 2 payments of $50.
Oh, don't whisper, tell them loud.
Yeah.
That's new knowledge.
Yeah, you reset the interest.
That's for a mortgage?
That's for everything that has interest on it. If you do your car payment like that, you beat the interest.
So if you pay it twice a month as opposed to paying extra, you beat the interest better.
Mm-hmm.
And do you know why that is?
That I can't say for sure. It just resets the interest on it. I was just reading about it like a couple days ago. Shit blew my mind. If you set your mortgage to like bi-monthly payments, instead it's like making an extra payment a year without actually making that money.
Could be because the debt is amortized, so, I mean, it's just the way the interest works. It's probably a huge math equation, but, you know.
No one understands.
Yeah.
Bro, they hurt to look at.
Yeah. I would also say, along with that, understand how these interest rates and how interest works in general. Understand the difference between amortized debt, which is like what we see in our car loans, our mortgages. Any fixed like loan essentially is typically amortized here in America. And understand the difference between that and lines of credit as well. You may have a mortgage or a car loan with like, I don't know, a 3% interest rate, but over time that actually is more expensive than like a 15% credit card, interest rate, because when it's amortized, it's just fixed. You got to pay that every single month, that same payment. But when it's a line of credit, you're paying that 15-17%, but every time you make a payment, it decreases, and you pay the 15 to 17% of whatever's left. So, you can even utilize those credit cards to, this is getting a little advanced.
You might want to leave that alone.
But you can even utilize credit cards to help pay off your mortgage faster, even though it's just shifting money from one area to another. So, but that's another conversation.
Yeah,
That's
that's
another
deep.
conversation.
That's deep. You gotta be responsible. You gotta be responsible to do that. It's playing chess, and that's a big game.
Yeah, that's a big game. That's what a lot of people don't want us to know, though. At the end of the day, especially minority communities, like that's something that I feel like it's a big gap in knowledge on how to manage money and how to move things around and how to utilize lines of credit to make sure you can pay off your bills faster. So I would say when you get into stuff like that, definitely read, definitely study, talk to Jeremy. You know what I mean? And just understand how that stuff works for sure.
All right. So we'll leave credit somewhat alone for a minute. Like I said, if anybody has questions in any topic, drop them as you go. And if we see it, we'll come back to it. We'll try to make sure we answer any questions that are there.
I do have a loan question.
Okay.
So debt to income. This is for you, Jeremy.
All right.
Let's say someone's a business owner.
Okay.
Income is typically different, looks different for business owners than it does for employees, right? how does it work when it comes, because business owners don't always, we got write-offs, right?
Right.
There's write-offs. So do they necessarily look at more so revenue, total revenue, or do they look at like more so the net when it comes to that debt to income?
A lot of it's net. There's a whole, it's called a SAM worksheet. We punch in all the numbers, what you claim your deductions, and like if you're claiming a loss, then they carry it forward. It's really weird. So if your profits are increasing, so your net income's going higher year over year, they average them.
Okay.
If it's decreasing, they take that and your year to date. And so whenever you're a business owner, you have to do like a year to date profit and loss. It's always one of those really weird things, and it's a terrible phone call. Like, hey man, your tax guy's really smart, man. Showing you lost $100,000 last year, that was great. But for mortgages, we actually have to carry that debt load moving forward. So if you know, a $100,000 loss, I have to literally include that in your debt to income. Like you lost $8,000 a month as a business expense. So now if your income's high enough, that doesn't matter. You make $240,000 a year, well then, yeah, fine, whatever. Now, if you pay yourself $100,000 a year out the business and your business lost $100,000 a year, then it's a wash.
Right.
So unless you have some other form of income, which that's cool too, yeah, it's a wash.
So you would say, so say for instance, we got a lot of people that sell clothes now, do nails, do lashes, whatever it may be, as entrepreneurs. For those entrepreneurs to then say, let's just say get into home ownership, do they have to, would you say, for the tax purposes, they have to avoid a lot of write-offs to be able to qualify for buying houses based on their income?
I wouldn't say avoid a lot of write-offs. What I would say is make your taxes reasonable. Sometimes I have people come in and they got a tax person. They're like, damn, my tax lady gives me 10 bands every year.
Just kidding.
Right. Look at the returns, and they got babysitting income, and they took a $12,000 a year loss against babysitting, and they're writing off all kinds of iPads, whatever. I can't, if you're not getting audited, it's none of my business. But for mortgages, I still have to take that $12,000 and break it up. So now it looks like you lost $1,000 a month.
So just be smart with the tax planning.
Right. If you want to buy a home, I
You
get
gotta
it.
plan for that. Probably
Yeah.
a couple years ahead.
There you go.
I got
Like getting over that's fine and dandy for sure. But if you want to buy a home, it always hurts. Another cool thing though, like a lot of people don't know that about rentals. Like if you can get a rental that cash flows really well, it can improve debt to income. That's one of my favorite things to see. So if you got a $500 mortgage on a house and you got a renter in there for $1,000, well, as a bank, we only take 75% of your rent to account for vacancy. And so it looks like $750 minus $500. So now you're positive $250 a month. And so now imagine you have 5 of those. Now on paper, it looks like you're positive $1,250 a month.
Right.
Plus, if you work, then now you're stacking. So you see people that work like average, not average, but maybe I make $80,000 a year. But I got 6 rentals as well. So now I qualify for a $700,000 house. Well, part of that is, having rentals. And then you put the renters in there, and what are they doing? They're building your equity, paying down your debt. They're helping you with tax write-offs. On top of that, I can depreciate the house as well. Like literally.
Hey, hold on, Jeremy, just to let you know, somebody asked if you do taxes as well. He's just a loan officer right now. He does not do taxes. Real quick though, we do have a question from Maribel. Not sure if this is already discussed, but what would the biggest thing be that you learned as a realtor? So I think that would be only for me, Jorge, but more so me, because I guess I've been a realtor longer.
There you go.
The biggest thing that I learned being a realtor, there's a lot of stuff I learned being a realtor. I learned that it's more of a people business than a money business because you deal with people a lot. That is your job. That's my job, to understand people, to figure out different people's needs, figure out people's personalities, to be able to find them what they want. Because a lot of people come to me with a pre-approval. All right, this is what I want. But then now I have to figure out how to help those people with my time and to benefit to still spread it out over all of my clients. So say for instance somebody comes and I want a 3-bedroom, 2-bathroom house. There can be 30,000 3-bedroom, 2-bathroom houses, but they're not for everybody. Everybody doesn't like the same house. So it's more of a matter of just understanding my clients, getting to know my clients more. So because building that relationship gets it done easier. If I understand what you want, I know before we walk into a house, if I see a house pop up online, I know you're not gonna like it. I can literally send it to you, say, nah, that ain't it. You send it to me, 6 o'clock in the morning, I wake up, I see that house thrown to me in a message. Nah, you don't want that one. Oh, why? Bathroom too small. I can tell you right now, that's not what you want. Like, it's more so building a relationship with people and being able to also take rejection. That's probably the biggest thing, especially in this real estate market, is taking the no's and still being able to find those yeses. Contrary to a lot of belief, that buy with Norm hashtags you see a few times a week, there's also a lot of Norm didn't get that house. In this market, I lose a lot, and it's a reality of it, because I'm not the only agent in Kankakee County. There's 30, 40, 50 other qualified agents that have qualified buyers just like me. So when everybody comes to me with that buy with Norm experience, they see the wins, but they don't see the losses. That experience of having those no's is what makes it easier to get those yeses, because now me losing teaches me more and more how to win. So when my clients come to me, I have to be brutally honest with everybody. It's more so, this is what we do to win. If this doesn't fit you, I don't want to push you to that. So say for instance, if a house is listed for $100,000, I'm gonna tell you right now, if 7 people want that house, you're not getting it for $100,000. And the reality of it, a lot of people don't understand that, because you don't go to a car lot and be like, yeah, that car is at $50,000. I'm gonna give them 60, so they give it to me. That's not how that works. And a house is different, because you could still, that house could be worth 120. It's priced at 100. In 5 years, it could be worth 160. The telltale indicator of a house price is dependent on a sole person that comes in and appraises that house. We don't know what it's worth, and a lot of times the bank won't let you overpay. But to compete, you have to offer those prices. So me losing allows me to educate my clients how to win. Sometimes they can do it, sometimes they won't. Sometimes I advise people not to win. Like, hey, if you want this, I know what price you need, but I don't think you should pay it. I have to be honest, that's part of what I do. Because if I sell you a house for $30,000 more than what you want to pay for it, and you hate it after 5 years, what you're gonna do when you see that house is think of me.
Right.
Like, dang, Norm let me pay $270 for the $240,000 house. What I'm gonna do now? I'm not calling Norm to sell it. That's the first thing. So I'm losing business by being dishonest and letting people overpay. That's a reality I have to work with every day, is making sure I'm doing the best thing for my people.
Yeah, and from what
Whoever comes to see me has to get that reality from me on a regular basis.
Yeah, and from what I've seen, from like the small amount of time that I've been doing this so far, it all comes with authenticity. Again, like if you're authentic with your customers or your clients, they will be authentic back with you, and that's how you get to know, like, all right, this is what they like, this is what they don't like. That's how you end up like knowing your customers. So again, if you're not authentic, they might not give you their authentic selves either, and that's how you're kind of stuck. Like, well, what do they like?
Yeah.
So yeah, I think like again, being like authentic, like you are being authentic to your customers, clients. That's a big plus, because at one point they will either open up and they'll like straight up tell you like, this is what I want, or just like you get to know them as like, you know, people, and because again, you deal with so many people, you get to know them as people, and I guess you do kind of get that like, oh well, they look like they would, like they definitely feel like they would want this type of like house, and then you send them that house and they're like, oh, I love it, and you know, but then you also like, again, like Norm said, a bunch of houses would come up for 3-bedroom, 2 bathrooms, and you can kind of tell if they give you back that authenticity. You can tell like this is what they'll like. Yeah. And again, you avoid yourself sending them a house that, in again 5 years, they might be like, wow, I can't believe he let me buy this.
Yeah, and they associate that with you. So the biggest thing I learned is that taking care of my clients' needs is what'll do me better for my business. So that's the biggest thing I learned as a realtor. Not necessarily selling a lot of houses. Being genuine and getting each person what they want is what's gonna do me the best in my career, because it comes with referrals. It's a referral business. So if I treat one person great, that one person might know 3 people. That one person might know 10 people. That one person might know nobody. But I still sleep better, and they'll call me another day. I might get invited to the Christmas party. I might get invited to the cookout. You never really know, but I pride myself on being genuine. That's the biggest thing I've learned, and that's the biggest thing that's been rewarding to me, because it builds your business. It builds my business. I can't speak of everybody. everybody might not benefit from that, but it does for me. So that's it. I answered that question. But on to, we'll keep going through the home buying since we're on that topic. He already talked about what you need to buy. In retrospective, I can speak from a non-lender perspective because I'm not a lender. He did mention you need thousands of dollars in the bank, things like that, depending on the situation. I am a firm believer that you don't always need money to buy, and we won't clarify on it all the way because it might confuse a lot of people, but at least to get approvals, you have to have money in the bank. So what do you mean by that? So say, for instance, you're going to buy a $100,000 house and you're using an FHA loan, which is usually 3.5%. That's straight out the gate, not including any down payment assistance program, any programs that benefit buyers. So you're going to buy a $100,000 house, you need 3.5% down. So that's $3,500. Technically, in the eyes of the bank, you should have at least $3,500 in the bank to get that approval for that $100,000 house. Now, to offset that, there's programs that I know they offer, Midland Bank, other banks offer it, the government offers it, and cities offer it. That's down payment assistance program. There's the IDA grant. We're in the state of Illinois, so we'll reflect on that. That's usually $6,000 that can go towards your down payment. That can, if you do the math, that offsets that $3,500 right away. There's qualifications you have to be with that. Everybody doesn't just get that right away. You have to have certain income. Certain, if you make too much money, you don't get grants. Let me be clear on that. You can't just, I make $300,000. Let me get that $5 about you. It don't work like that. Illinois is not going for it. But there's plenty of ways to not actually need the money that you have to have, if that makes sense. It's a real messed up scenario, and it's a lot of confusion in that statement. But to be clear, banks in the state and the cities have a lot of benefits that don't require you to have money or a lot of money to buy a house. You might need the bare minimum. I've had plenty of times, literally multiple times, where I've had people close with $1,001, $1,030, like for a $150,000 house, $180,000 house. There's benefits to buying houses, and most of those grants are not repayable grants. You just have to stay in the house a certain amount of time. Now, I don't know if they're gonna flag my Facebook for saying that, but it's being authentic. You don't need money per se to buy a house. You just need to, one, be financially responsible, have the credit to qualify for those programs. So a lot of people call me, man, I got a 580 credit score, get me in a house, no, I'll be like, I'm not a magician. I never professed to be, so it's a lot harder. Yeah, basically, because there's ways to offset it. You got a 580 credit score, but you got 20% down payment, so 20% of whatever that house price is you want, you can probably get that house. But a lot of people don't have $30,000 sitting at home waiting in the shoebox ready to buy a house, or in a bank account ready to buy a house. It doesn't work like that. I work with a lot of people to educate themselves to use their credit to not have to use their money all the time. If you have the money, use it definitely, because that money doesn't go away if you put it into a house, in my opinion. And by factual data, most times it does not go away. Usually real estate makes money over time. Also in that topic, a lot of people argue with me right now because the market's so high that they might be overpaying. I'm not one to answer that question fully. I'm not gonna lie to you. I will say that it's very hard to do so in a house because banks do have appraisals. If you're using a bank, the bank always comes in, unless you have the right to waive appraisal. Usually you got to put down 20% to do so because you're at the equity value of the home, but that's a whole other thing. Usually the bank has to do an appraisal on every single transaction when you finance a home. That appraiser then comes in, bases off comparable homes. Now obviously houses are selling for a little more, so those appraisals mean more, and they're a little more scrutinized based on the market. So usually, you might have bought a house as 150, 6 years ago it could have been 130. But if you look back 30 years ago, 20 years ago, that house was 60,000. So people see it as, hey, the market's high, I'm overpaying for everything. Yeah, you might say that. People are like, should I wait to buy a house? Yeah, cool, if you want to. I can't tell you I'm a psychic, I don't know. But my biggest thing is, this is a whole other thing, we can talk about it if we had to, somebody asked. I'll leave it alone. But real estate only grows over time, in my opinion, from reading, from growing. The whole market crash thing is a big thing that I want to talk about, but we might not have time. If somebody asks, I might dabble on it, but I have my own theories based on my readings, my understanding of how the banks work back then versus now. Like, there's a lot of protections in place to defend and tell you, you might not want to wait too long if you're waiting on a crash, because I don't think it'll happen. If it does, I'm sorry, I lied. But it's very hard to say it can happen based on how things work versus from then versus now. But either way, if anybody has any questions, feel free to drop them still. I will check in.
We do have one.
Okay.
to say, like banks are really overregulated right now. A lot of people don't understand the appraisal situation that's based on comparable sales in the last 6 months. So if, everybody in the neighborhood's selling and they're all going above what they were even 2-3 years ago, then yes, the next house that sells will appraise higher than it normally would have. And it's just, it all feeds into itself. It's really weird. As for what he was talking about, where you don't actually have to have money, he's right. For some of these programs, I think you need, for one, you just need $2,000, and appraisal fee counts, cash deposits on contracts count towards that. So when you get into lending and you're going to buy your home, you're going to need money for a home inspection. You're going to need money for the appraisal. You're going to need money for your deposit on your contract. And that's why I say a couple grand. A lot of people show, $4,000 or $5,000 in the bank. They don't use that. And that's because in Illinois, taxes are paid in arrears. So we're paying for this year, next year. So when you go to buy a house, say you go to close on it next week, whoever's been living in this house since you got the tax bill for next year, they owe you for 10 months of that. So hey, if you got $5,000 yearly taxes, well guess what? You're gonna get a big tax credit that goes against your closing costs. So one of the weird things that I see when people buy in more expensive areas, they pay less in closing. And when they buy in cheaper areas, they pay more because the tax prorations eat up less of the closing costs. So you don't really need that much money to buy a house. Yeah, he's right. But you do need to show something, because I can't use tax credits to pre-qualify anybody. Unless you use IDA. That's just one program. If you're using down payment assistance, Kankakee County limits are $102,000. You make less than that, you can get $6,000 non-repayable, $10,000 or 10%, whichever is lower. But you have to pay it back. It's a interest-free loan, and they all are treated as secondary mortgages. So if you use that program, and sometimes we'll use that to qualify somebody, because then we can show tax credits. You come to me with $1,500 in the bank, I slap IDA on there, I do a tax proration calculation, and now you're pre-qualified. And a lot of lenders can't do that, but that's the only scenario that you can do that.
So you're a problem solver when it comes to money. You figure this stuff out.
Oh yeah, we closed one last week. We had to put 2 forms of down payment assistance on one loan. And I felt like it was that 07 shit all over again. I'm like, damn. Oh, I'm sorry. Felt like it was 07. I'm like, man, we got him like $16,000 in down payment assistance.
Wow.
So if you qualify, we can do it.